This is a risk and return story. This is not about making a green investment and giving up return to do something good. This is a pure risk and return allocation.
Whether or not you believe in the science of climate change, the political tailwinds are there. This transition is happening. Businesses are taking action, markets are taking action, and investment flows are starting to move into decarbonization.
This is not a 30-year story. The moment we start to see where this price will be in the future, a discounted version of that will be discovered today.
This is going to be the headline story for investors for the coming decades. Carbon markets are a way to put a price on greenhouse gas emissions, to make the dirty stuff more expensive and make the clean, green investments more attractive.
There's really two different types of carbon markets. There's the offsets, where people are growing trees and corporations are offsetting their emissions. That's not what we're going to talk about today. That's the voluntary offset market. Today we're going to talk about the carbon compliance markets. These are official government-sanctioned, mandated programs where companies within the European Union, California, the northeast of the US, the various other programs that cover different economies, set a cap on the amount of carbon that can be polluted, and then they sell permits.
Essentially, the way carbon markets work is through a cap-and-trade program. So there's a cap placed on emissions, typically across the economy. That cap goes down over time, and then there are an allowance that's issued by the government, which is purchased by companies that fall under this cap. Those companies have to monitor their emissions over the course of a year, which is used to lower greenhouse gas emissions and using a market mechanism to do that.
By putting a price on carbon, it now makes sense to invest in decarbonizing technology, which is where the economy is going.
The idea of using a market to solve an environmental challenge is not new. Acid rain is really not a big problem that we talk about anymore. And why? Because we used a cap and trade system to deal with the challenge of acid rain. The first one was really in Europe, where continues to be the largest, most liquid carbon market in the world. It's called the European Union Emissions Trading System, started in 2005. We also have one in California, we have one in the UK, and then we have one in the northeast of the United States called the Regional Greenhouse Gas Initiative. Carbon markets are actually institutionalized also within the Paris Agreement, so within the UN system, and so we're seeing carbon markets expanding into other regions. So we've got markets in Korea, in New Zealand, in Washington State, in New York State, and then notably, we have an emerging carbon market in China. China, of course, is the largest greenhouse gas emitter in the world. So the market in China could, in fact, become the largest carbon market. Why is carbon pricing so compelling now? From a policy perspective, from an investment perspective, and I think we need to start from first principles. We are facing an unprecedented anomaly, which is the rise in temperatures caused by greenhouse gas pollution. So if you look back at the last million years, we have data from ice cores that tells us what the concentration of carbon dioxide is in the atmosphere over the last million years. And it stayed in a very narrow band of between 200 and 300, what are called parts per million of CO2. And the difference between 200 and 300 could be the difference between an ice age and a major warming trend. Where we are today is over 420 parts per million. We've never seen that level of CO2 in the atmosphere. We're using carbon price to solve climate change, which is perhaps the largest macro trend facing our generation and the next several generations.
The global economy is always changing. It has always changed. And we're going through a new stage of change in the global economy. Change creates opportunity. We are moving towards a renewable energy future. But what's missing is the scaling and bringing down the cost of those technologies. Governments have now put in a price of carbon, which will incentivize companies to start making those switches, to start investing in scaling those technologies. And it's that scaling that is going to create great values in these companies, but the lever is going to be the rising price of carbon. And that's why we think you should be invested in the carbon markets to allow you to participate in that government regulation, in that tightening of climate action.
Whether or not you believe in the science of climate change, the regulation, the political tailwinds are there. This transition is happening. Businesses are taking action, markets are taking action, and investment flows are starting to move into decarbonization. We are now in the midst of, and I would say the beginning of, a massive decarbonization of the entire global economy. This is going to be the headline story, I would say, for investors for the coming decades.
This is not a 30-year story. As we all know, we're all investors, we all know how pricing works. The moment we start to see where this price will be in the future, a discounted version of that will be discovered today. And what's unique about these markets is that the scheduled decline in the cap in these markets is going to drive that. Europe, since 2019, has been in sharp decline of supply, and that's where we've seen the price take off. California, at the end of 2022, and we're here mid-23, we're seeing this inflection point where supply is no longer enough for the demand, and the demand is now taking over relative to that supply, and we're seeing that crunch that is pushing prices higher. So we're at this very important inflection point that the pricing and the lion's share of the upside is going to be achieved in the next couple of years. Why this is so important for investors is the market has been structured so that investors can participate. In fact, they're encouraged to participate because having investors and speculators in a market, like any market, is going to create price discovery. These markets are developed to create a rising price of carbon that will incentivize and accelerate the decarbonization of the global economy.
This is not a niche market. Compliance carbon markets are nearly $1 trillion market. If you look at the supply and demand dynamics of these markets, we know what the supply is, right? The supply is the cap that's implemented by the regulator. And unlike most markets, this supply is designed to go down over time. There could be a surplus of allowances in the early days, but as the markets get closer to the emissions targets, they flip. We go from a surplus to a deficit of allowances. In other words, the markets go from a structural long to a structural short position. In the places where these markets are, we're seeing regulators pull targets forward, make caps stricter, which all has the impact of tightening supply and raising prices.
So currently today, the average price of global carbon, according to the S&P index, is about $47 per ton. Bloomberg has forecast $160 a ton of carbon, or 160 euros, and that is a significant increase from that average price today. So there is a great opportunity for investors to be part of this price discovery that we are in the middle of now. So as that price rises, we will see the necessary decarbonization of the economy into renewable energies, but we're also going to see a much higher price. So you can be long that asset. You can be long the price of carbon as it rises to meet those goals. So really, you're not taking a bet on the climate, you're not taking a bet on the atmosphere, you're not even taking a bet on the companies, but you are taking a bet, a position that there will be increasing tightness to the ability for companies to use high-intensity carbon processes. And that is already underway. Global governments, recognizing the need to scale the existing technologies, are creating a carrot and stick. The carrot is programs like the Inflation Reduction Act, spending $360 billion on renewable incentives. The stick is the price of carbon, making it uneconomical to continue to pollute at the existing levels. So the stick is what we're talking about today. By putting a price on carbon, you incentivize switching away from high carbon intensity or polluting processes.
We have a voluntary market and a compliance market. On the voluntary side, we have corporations that may not be regulated that are taking action on climate change, voluntary action on climate change. Relatively small market, let's say $2 to $4 billion. On the compliance side, much larger market, right? It's nearly $1 trillion market now. And the compliance carbon market works again through this cap that goes down over time. There are companies that fall within that regulatory regime. Normally these are relatively large emitters. Those companies need to buy allowances. So the allowance is a unit, a tradable unit that's issued by the government, by the regulator. At the end of the year, they need to hand into the government the number of allowances equal to their emissions. There's a huge incentive on the companies that are regulated under compliance markets to purchase these allowances and make sure they've got enough of these so that they can operate.
And what's great about it is that it doesn't tell companies what to do. It's not anti-business. It doesn't say you're not allowed to do your business. It doesn't say you're not allowed to pollute. It simply says you must buy these allowances for every ton of pollution you put into the atmosphere. And what that creates is a survival of the fittest, completely in line with our capitalist beliefs. That is, if you want to survive, you must innovate, you must be more efficient than your competitor. And so this is driving that change. The whole objective of this market is to steadily increase in price while mitigating various industrial processes and shifting them towards renewable versions of themselves. This is a risk and return story. This is not about making a green investment and giving up return to do something good. This is a pure risk and return allocation. You have volatility, but you also have great diversification benefits. We think those diversification benefits continue into the future because of the way these markets are structured, unlike anything else in the market. We've got very low correlation, about a 0.3 to US equities, that mean that though volatile, carbon markets will actually bring down the overall volatility of the portfolio. Most companies that you already own are going to be exposed to the price of carbon. And if those companies are exposed to the rising cost of carbon, that's a cost to those business. So we've seen increasingly that allocators actually want carbon in their portfolio as a hedge to their equities. This is purely a financial decision and a portfolio decision. And that's why we are so bullish, not just carbon, but the expansion of the carbon markets as an allocation in all portfolios. At KraneShares, we developed our climate suite of ETFs to focus on what we see as the three pillars of investing in this global transition. So number one is the carbon markets, number two is the transition equity markets, and the third one is the natural resources like cobalt and lithium that will be needed for that transition. But the purest play here, the play that should go from bottom left to upper right, is the price of carbon, and it should do so with low correlation. And that's what makes carbon so attractive in playing this transition. Where the liquidity and the access is in the futures markets. Now, we often get the question, don't futures have contango? Don't they have a roll yield? Isn't there a cost to carrying a futures position? Carbon is a financial asset. It reflects the price of 1 ton of pollution. So that cost of carry looks very much like the money market rate. And of course, when we put on that 1-year future in carbon, we're able to invest our collateral into money markets and earn back that risk-free rate. So for the most part, the curve is very flat and is not a material cost to investors in an ETF like ours that tracks these carbon markets.
The flagship KraneShares product is KRBN. And KRBN we envisioned as a way to give investors access to a global carbon price. But it's not easy to access these markets. What KRBN provides is access to a global basket of the largest, most liquid, oldest carbon markets in the world.
It includes Europe at 60%, California at 30%, and 5% each to the UK and RGGI. That is the global, that is the benchmark, that should be the core holding of a compliance carbon portfolio. And then for those investors that are really getting deep into this, as many of our institutions are, we have a California only, which is KCCA, and a Europe only, which is KEUA.
Carbon markets aren't going away. When they are implemented, they're typically the core strategy in these regions to deliver their climate goals.
This is simple evolution of the energy markets and of the industrial markets. So we're going to see the scaling of technology, we're going to see a reducing cost of renewable energy. Global carbon markets offer a structural upside, high diversification benefits, as well as an impact factor.
Market's already at $1 trillion. this can double, triple, or more over the next few years.
To access carbon markets, you need a vehicle that is transparent, liquid, and also cost effective. And that is what we deliver through the KraneShares Carbon ETF Suite.